Hello and welcome back to Dukascopy TV. Now, with more twists and turns than a poorly constructed fairground ride, the European debt crisis continues to take its toll on the Eurozone nations. Hervé Prettre from Credit Suisse joins me in the studio now. Hervé, thank you very much for coming in.
Thank you for the invite.
Now, the Spanish budget released yesterday was more spending cuts than tax rises. Correct move, do you think?
Well, there are three reasons for that. First, with unemployment rate now at 25%, mortgage delinquency at 14%, bad debt within banks close to 10% of total debt. How much do you think they can afford putting even more pressure on the private sector? That's quite impossible. Second, I would say look at the philosophy of Draghi's plan released a couple of weeks ago, is that the European Central Bank is ready to directly buy bonds from, extending existing bonds in the short maturity up to 3 years, preventing that the local governments put their house in order. The problem with spending cuts, you can trust them. That we used to have, 100 million spending for culture, then we cut it, then we know it's going to happen. We saw with the Greek example, and former Prime Minister Papandreou stated, trust me, I'm going to raise taxes and I'll make 10, 20 billion more by the end of the year. And then he came at 1 year and said, well, it didn't turn out because of the depression we had as high as we expected. So I'm sorry, I can't deliver on the tax rise I promised. Europe, particularly Germany, wants to avoid that. We can't trust tax rise because we are depending on the economic growth, which is, we know that can be much worse than expected, and therefore, if you want to have some clear commitment to be able to activate those emergency funds, Spain needs to have some trustworthy figures about, and spending cuts are more trustworthy than tax rises.
It's been argued that Rajoy has been let down by several of the Eurozone nations, Germany in particular as a creditor country, but with shrinking lending and rising unemployment coupled with low business growth, it's hit a 3-year low now. Germany has its own domestic concerns, really. How long can Germany continue to be the main engine of the Eurozone economy? Well,
it is still, but you have to view it in a relative way. We're not talking about an 8% growth per annum momentum such as China. We are talking about 0.8% to maybe 1% economic growth this year, 1.2% next year, which is much better than the minus 0.4% expected for the Eurozone this year, and about 0% next year. So in relative terms, yes, it's still the strong spot of Europe, but very tiny on an economic growth perspective. Germany actually is quite tied to Southern Europe and to France because those are still remain its main export markets. And if you have a huge pressure on corporate spending and consumer spending in France, Italy, Spain, of course the German exporters will suffer from it. So definitely its economic growth will decelerate, but still be outpace that of Europe.
The IMF has also cautioned this week emerging markets and developing economies against the looming risk of Europe and the US. Is there the concern, therefore, that investors will look away, foreign investment will sort of turn away from Europe to avoid that risk? Or do you think the sort of relatively low-risk periphery countries in Europe will sort of remain attractive?
Well, two things. First, we can't say that foreign money is escaping Europe. They make their choice. If you look at the 10-year bond yield on Germany or France, 1.7, 2.2, money is still there. Or the Netherlands, 1.7 is for Netherlands, 1.4 is for Germany. Those countries are still attractive, of course, with 10-year bond yields above 5%, close to 6% for Spain. Those are the weak spots where international investors are quite cautious. But look at the philosophy of Draghi's intervention 2 weeks ago now. A very important point is that on top of directly buying some with this new OMT mechanism, some outstanding bonds on the market. One very important point is that the ECB and Europe will lose its status of privileged creditor, meaning that they want to attract private investors into Spanish, Portuguese, Irish bonds too. So far, there has been very little of it. Why? Because should anything happen in terms of bankruptcy, Europe, the public lender, the European public lender, would be privileged in case of debt restructuring. So you would lose your shirt as a private investor. Now that this privilege has been removed, a private investor will be considered in case of restructuring, same as the ECB or European or IMF lending. Therefore, they hope through this change to attract more private money. It hasn't turned really so yet, but should Spain, with a clear budget, ask for European help, then chances are high that you see more purchasing of private investors too of Spanish bonds. So we'll see what happens in the coming weeks.
And what impact is this all going to have on the euro in the sort of short to mid-term future? It slid immediately following Spain's budget release. What's Credit Suisse's projection on the euro?
Well, that's interesting because for us, the intervention by Draghi changed a lot. We used to have 118 price target euro-US dollar in 12 months because the US is improving its trade deficit, because the US economy is being kickstarted much quicker than that of Europe. However, we changed, and now our new price target is 130 in 12 months, because we expect the intervention by the OMT mechanism to draw investors' attention, to relieve investors from the fear that the euro might disappear, as there's quite some unlimited ability now for Europe to intervene, bail out Spain through unlimited bond purchase, same for Greece, same for Portugal. So we estimate that the euro is likely to recover lost ground on back of this. Of course, a big move has been made. We're already at 128 now, so we expect all in all this more relief in Europe, together with very weak economic growth and rather pretty good economic growth on the US side, to make some stability in the euro-US dollar parity within 12 months. As mentioned, we have a price target of 130 next year.
Great comments as always, Hervé. Thank you very much for joining us.
Thank you.
That's all we've got time for right now, but for more interviews on this topic and more, stay tuned to Dukascopy TV. For now, goodbye and have a great weekend.